Welcome back, students who are taking financial accounting, and in this series of videos we are working on the assigned homework problems for from the digital study guide for chapter 7, the exercises group B. Note, accounting is about understanding the concepts and then applying that understanding to the situation at hand. If you get the application aspect wrong, that is one thing and is easily remedied by watching someone else work the problem. However, if you don't understand the concepts, that is a whole other thing. Watching a problem worked out will not help if you do not understand the underlying concepts. Go back and study the text material again and watch the theory videos. If you still don't understand the concepts, then either email or telephone an instructor to get help with that understanding. So we left off on problem 7-39B. Get my pen. And so it says here, Sanchez Enterprises sells on account when a customer account becomes 4 months old. Sanchez converts the account to a note receivable. So they're selling on account, which is an accounts receivable. And then when it becomes 4 months old, they're converting it to a note receivable. During 2014, Sanchez completed these transactions. So these are the three, and then record the transactions in Sanchez Enterprises journal. So we're making journal entries. And so for January 31st, sold goods on account to Jitzer Coffee, $12,000. Ignore cost of goods sold. Simple transaction. Should be able to do this by now. Are you affecting cash? No. All right. Are you affecting accounts receivable? Yes. So you're going to debit your accounts receivable for $12,000, and you're going to credit your sales revenue for $12,000. Okay, so on June 1st, received a $12,000 60-day 7% note from Jitzer Coffee in satisfaction of its past due accounts receivable. Right. So according to this, if the account is 4 months old, it converts it to a note receivable. Well, if we're going to convert it to a note receivable, we no longer have the accounts receivable. All right. So we're going to credit our accounts receivable to get it off the books. And then of course we're going to debit a notes receivable and Jitzer Coffee for $12,000. All right. You might want to, if you watched the previous video, exercise 7-38B, I did go into a discussion on making notes for the journal entry, putting a description for the journal entry. This is a case where I would make a note saying, that you converted the accounts receivable to the notes receivable, and I put the terms in 60 days, 7% note. Right. So then on July 31st, collected the Jitzer Coffee note at maturity. June 1st to July 31st is 60 days. Use a 360-day year. Okay. For the interest computation and round to the nearest dollar. All right. So let's make the interest calculation because, all right. Well, all right. First, let's make the interest calculation because we know we're going to receive cash, and we also know we have to reduce the note receivable to 0. Okay, but the issue is how much cash are we going to receive? I mean, sure, you're going to receive a check in the mail. That's going to be $12,000 plus interest for some amount. But you can't just take it for face value that that amount is correct. You have to do the calculation for yourself to make sure, because they could have made an error. And so you have to do the interest calculation for yourself in order to know what that amount should be. So it was a $12,000 note, and it's at 7% interest, and it was for 60 days over 360. And so let me get my calculator here. you're going to take the 12,000 times 0.07 times the 60 days, which gives you, get my pen here, which gives me 50,400, and that's going to be over the 360 days. And when I divide by 360, I end up with 140. So my interest is $140, right? So we're going to get interest revenue, right, for 140, so we're going to credit interest revenue for $140. We know we're reducing the note receivable to 0, so we're going to have to credit our note receivable JC, the Jitter Coffee, for 12,000. Oops, wrong spot. For $12,000, and we're going to receive cash, debit our cash, for $12,140. Okay, and those are the 3 entries for this exercise. All right, moving on. 7-40. All right, it says here, consider, all right, quick ratio and current ratio. All right, just as a quick aside, current ratio is the current assets over current liabilities. The quick ratio is quick assets over current liabilities. And remember, the difference between quick and current, current is now through 12 months from now. In other words, it's, between now and a year. That's what's considered current. But our quick generally includes the receivables, all right, between cash and the receivables, because we can convert those over relatively quickly. All right, the quick assets are a subset of the current assets, and that's why you have the 2 different ratios. All right, so here's the data. All right, we have cash, short-term investments. Those are marketable securities. If you watch the theory videos, I explain that they don't. I don't know why they use they could use the term short-term investments, but a lot of businesses use the term marketable securities, and so their chart of accounts, you'll have a tendency to see cash, then you'll have petty cash, then you'll have marketable securities, and then you'll have your accounts receivable. And of course, if there's notes receivable that are like 30 days or whatever, it makes no sense to have a note receivable for 30 days. But so this is the way your chart of accounts would look. Here they're calling it short-term investments instead. Then we have the net current receivables, and then total current receivables, and then our current liabilities. Right? So calculate the quick assets and the quick ratio for each company, and then calculate the current ratio for each company, and then which of the companies should be concerned about its liquidity. All right, so all right, let's see how I want to do this. Okay, so I'll just do the math down here. I'm going to scribble across the page, and when I run out of space, I'm going to erase. So pause the video wherever you need to. All right, so we're going to look at company A here first. All right, and I'll call this the Q is quick, and C is the current. All right. And I'll just put those amounts underneath here because we have to compare them to see now we just have to think about which one we're going to be concerned with liquidity. All right, so for current assets, for company A, for the quick ratio, all right, we're going to take the 95,000 plus the 85,000 plus the 120,000. Right there, okay, and that'll be the same all the way across the board, okay, and so that'll give us, let's see, 10, 20, 300,000, and we'll divide the 300,000 by the current liabilities of 200,000, and that'll give us a quick ratio of 1.5. So this is 1.5, and if we take our total current assets of 325 and divide that by 200,000 of our current liabilities, that gives us 1.63. Okay, so that's A. B is the same. All right, so we've got 67,000, 30,000, 113,000, which gives us 10, 10, 11, 210,000, and we're dividing that by 255,000, and that gives us 0.82. And then we take the 224,000 and for our current ratio and divide that by 255,000, and that gives us 0.88. See? Now the thing about this here is, you're given 4 different scenarios here, and even though we're doing basically the same math, try to, in your mind, treat each one as if you were approaching it for the first time. I mean, you just saw me scribble down, 3 numbers here, and you just saw me do the math for 84,000, and then I'm going to divide it by 60,000, because that's what I did for A and B. But really what you should be doing in your mind is saying to yourself, okay, I'm working on the quick ratio here. Well, what are my quick, my quick assets? It's my cash, my marketable securities, and my net current receivables. And then I divide that by my current liabilities, because that's the ratio, right? And so you're given 4 different scenarios, but treat, in your mind, treat each scenario as if it was just the first time you're looking at it, and you have to think it through. If all you're doing is just writing down numbers and doing the math, then you're missing the point of the problem. Okay, so 84,000 divided by 60 gives us 1.40, and then the same thing for your current ratio. Current ratio is your current assets of 96,000, and you're dividing it by your current liabilities of 60,000. Right? And that gives you, let's see, 1.60. And also think about, what's the purpose behind having a quick ratio and versus a current ratio? I mean, why do you have 2 different ratios? Okay. So I've got 103, 53, 145. So that's 611, 10, 301, and that's over 260. Divided by 260, so 301,000 divided by 260,000 is 1.16 for my quick ratio, and 368 divided by 260 gives me 1.42 for my current ratio. All right, so then we just did number 1, we just did number 2, and number 3 says which company should be concerned about its liquidity. Right, and that's why I had said, think about what the purpose behind the quick ratio is and what the purpose behind the current ratio is. The company that needs to be concerned is company B. All right, anything less than 1 is not a good number. Okay, so the general cutoff point is 1.0 as part of the ratio. When you get less than that, you don't have enough assets in order to be able to cover your liabilities. All right, so it's like saying, okay, think of it from this perspective. You have 2 different people, person A and person B. If person A gives person B $1, okay, then person A has, that's their dollar, and person B owes that dollar, right? Now, if during the very next day, person B did not spend that dollar, okay, then they're able to pay off their, they received $1 in cash. Maybe if I write it down, it'll look good. If you have person A and you have person B, and person A gives person B $1, okay? For person B, their journal entry is cash for $1 and a liability, right? Or accounts payable, maybe we'll call that, for $1, okay? And notice that the cash is an asset and liability is cash is a current asset and your accounts payable is a current liability. So it's a one-to-one kind of thing, meaning, if this happened on January 1st, and person B doesn't spend the money, okay, then the very next day, right, on January 2nd, they're able to pay the $1 back because they still have the $1 in cash and they owe the $1, so they're able to pay it off and they're good to go. But let's say that on January 1st, person B goes out and spends 25 cents on a newspaper, okay? Well, now person's B cash is 75 cents, right? But their liability is $1, okay? If they have to, if person A says, I want what you owe me, person B cannot pay it back, all right? Because they only have 75 cents, all right? So that's why a good ratio is 1-to-1 or greater. But now let's just say instead, person B, they borrow the $1, and I'm going to do this in blue instead. Person B borrows the $1, okay, and they go to a store and they buy something for $1, all right, and then they turn around and they buy something. I'm just going to make something up here. They buy a notepad for $1, okay, and later on that day, they find somebody that'll buy the notepad, right? And they buy it for $1.25, okay? Well, now person B has cash of $1.25, and their liability is $1, okay? So, their ratio here is 1.25. It's greater than 1. All right. So if person A turns around and says, "Hey, I want you to pay me the money that that you owe me," well, then person B has the cash to be able to pay off that $1, and they're still left with 25 extra cents. Okay. So that's why the 1.0 is a good point. Is the measurement for whether you're in good shape or not as far as being able to pay off your quick liabilities, your current liabilities, either via looking at your quick ratio or your current ratio. Okay. So that was, even though this exercise is, well, it says 15 to 20 minutes, it only took me 6 or 8 minutes to do the problem, and then my extra explanation took a whole extra 10 minutes, but hey, such is life. All right, let's see here. And with that said, I'm going to stop here and pick up the next video, this last problem in the next video. If you didn't understand something, feel free to, go back and pause, rewind the video, watch it again, go back into the theory, and if you still don't understand something, feel free to contact an instructor.